The very first question that people ask when they set up a company, what is a relationship between themselves and a company? Now, obviously, you have set a company as a separate legal entity. So being a separate legal entity, company has its own legal obligations and responsibilities. So you have to record each and every single transaction related to you. Second question that people ask, what can I use director's loan account for? Technically, company is here, money is here. You can use money for anything, whatever you want, from a small repair and maintenance expense to unexpected holidays. You can use money whatever reason you want. However, the money you use have an tax implication on company as well as on yourself. So you have to bear in mind all of these tax implications before taking money from a company. So now don't worry about the tax implications. I will explain all of the tax implications here. So in this video, we take a closer look on director's overdrawn balance, how the impact can be reduced or avoided, and what are the tax implications of director's loan account when company owe money to directors or directors owe money to company. So in this video, we are going to cover three important concepts. Number one is what are the tax implications when director has a overdrawn balance. Number two, what are the tax implications when director has a credit balance. And number three is what are the tax implications in terms of bed and breakfasting rule. So let's deep dive. So the first one is what happens if director loan account has a credit balance. So in this case, if director loan account has a credit balance, it means company owe money to director. So director can withdraw money at any point during the tax year. However, bear in mind, if company paid interest on that money that company owe to the director, then director has to declare that interest in his personal tax account as a interest received from company and will pay income tax on that interest that received from the company. And the same interest amount will be tax deductible for company while calculating a tax liability. So this one was quite simple and straightforward. Company owe money to director. However, complexity arises where director owe money to the company. So bear in mind, if director owe to the company more than £10,000, so HMRC view it as a beneficial loan to the director. So in that case, there are two tax implications. Number one is company has to file P11D to the HMRC, and on that P11D, it has to pay class 1A national insurance, which is 13.8%. Second implication is director has to declare that P11D amount on his personal tax return and pay income tax return or income tax on the marginal rate, either 20%, 40% or 45% on the income that he has. So in terms of corporation tax implications, it depends on when director repay money to the company. So number one is within same accounting period, director repay back money to the company. So in that case, company does not have to pay any corporation tax charge on the money that director owe to the company, and it does not have to declare on corporation tax pages, which are CT 600A. So there are no tax implications if director owe money to the company and repay back it to the company within the same accounting period. Number two is director didn't pay money back to the company within the same accounting period. However, it does repay back money within 9 months and 1 day of accounting period. Let's say accounting period is 31st December 2023 and director repay money on 30th of April 2024. So it means he repay back money after 4 months of accounting period. So in that case, company does not have to pay any corporation tax on the outstanding amount. However, company has to disclose this amount into the corporation tax pages, which are CT 600A. Number three is loan is still outstanding after 9 months and 1 day of accounting period. So we are taking same example. Accounting period is 31st December 2023 and we are preparing accounts in May 2024. 9 months and 1 day of accounting period is 1st October 2024. He has confirmed that he does not have any any intention to repay back loan on or before 1st of October 2024. So in that case, company has two corporation tax responsibilities. Number one, company has to pay S455 surcharge of 33.75% on outstanding overdrawn amount, and second responsibility is company has to disclose this outstanding loan or overdrawn balance of director loan account into the corporation tax pages on CT600A. And now second question comes up, what if once company has paid this surcharge on the director outstanding balance or overdrawn balance to the HMRC, does it reclaimable? So yes, company can reclaim back corporation tax charge that he has paid on overdrawn balance of director's loan account from the HMRC by filling L2P loan to participant or participator form. But bear in mind, there is a condition for reclaiming this loan from corporation tax from HMRC. So company has to reclaim back this loan within 4 years of filing of the tax return. Number 4 is company write off director loan account overdrawn balance, or there is any other reason. Let's say company goes into liquidation and director didn't repay back director overdrawn balance to the company. So in that case, director has untaxed income. So director has a responsibility to disclose this income on his personal tax return and pay income tax on this amount. So now there are few exceptions to S455, in which case company does not need to pay S455 charge on director's overdrawn balance. So number one condition is director loan account plus any outstanding balance after the year end does not exceed 15,000. Condition number 2 is director work full time for the company, and condition number 3 is director does not have any material interest in the company. And number 2 is material interest defined as if director own 5% or more than that of the associate of that company, and by owning that associate, it means he has interest or material interest in that associate as well, and on its liquidation or winding up, he will have access to its assets or value of the assets when they liquidate that. So if any of these conditions, then company does not have to pay S45 charge to the HMRC. However, we normally consider that if director has overdrawn balance of more than 10,000 pounds, then we definitely charge S455, or we advise clients to repay back money to the company bank account. However, before doing any of these things, consult with your accountants and they will guide you through what are the best course of action for your circumstances. The final concept under director loan account or director's overdrawn balance is bad and breakfasting rule. This is so important because here where the tax avoidance comes into the point. So some directors manage their DLA balance or director's loan account balance in a way that they can avoid tax efficiently, which is known as bad and breakfasting rule. So this method directors use sometimes to dodge tax authorities and to avoid any interest, penalties or surcharge on their director's loan account overdrawn balance. So what they do is before the year end, let's say they have 10,000 pounds on, let's say 20 December 2023, and the accounting period is 31st December 2023, and on 25 or 26 December they make a transfer of 10,000 back to the company account. So in that case, on the year end 31st December 2023, they don't owe any money to the company. When accountants prepare accounts, so they satisfy there is nothing outstanding from the director. However, right after the year end of 31st December 2023, let's say 5th of January, they transfer from company bank account back to their personal bank account, let's say 10,000, 12,000 pounds. So this is called bad and breakfasting rule. Before the year end, they transfer their money from personal bank account to the company bank account to avoid any interest penalties or surcharge, and on 5th of January, from company bank account to the personal bank account, they again transfer money into their personal bank account. So this is called the bad and breakfast fasting. Now let's say director has repay back money to the company on 25th of December, withdraw again money on 5th of January, and if the money is more than 10,000 pounds, so HMRC view this as director does not have intention to repay back money to the company. He does so to avoid S455. So in that case, HMRC underline a very simple rule. They said if that is the case, then the whole amount will be taxed. So in that case, some directors ask, how can HMRC prove that we don't have intentions to repay back money to the company? So in that case, HMRC always view pattern. You have outstanding money on 20 December 2023. On 25th December, you repay back money to the company before the year end of 31st December 2023. 5th of January 2024, you withdraw money from the company again. Alright, so this is a repeated pattern. So HMRC view it as your intentions of not repaying back money to the company. I tried to cover whole director's loan account, its tax implications, and how does it work. However, if I still miss any point or any important element of director's loan account, I would appreciate your interest by posting a comment in the below chat and let me know what elements or points have I missed during this video. And please let me know what other topics or areas of the taxes you guys want me to post a video. So as always, hands ahead, salute until the next video.